So then finally, and this one is the one that we're going to focus a little more time on, and it's really going to be estate preservation. Now, I'm using preservation as opposed to estate plan, in other words, is because really for this type of client, they're really looking to preserve the assets that they have and allow their heirs to continue to have these assets without having to kind of foot that tax bill. So really that, like I said, prevents that need for that liquidization, and can also provide additional wealth to the beneficiaries. If the state tax liability is $7 million on what they have, and they have $10 million of death benefit, guess what? They're now being paid an additional $3 million split to your beneficiaries once that tax bill is paid. It also allows for the equalization of those indivisible assets. So anything like real estate, art, any other type of property, businesses, something that is not able to just be like, here's an account value, split it in half or split it in thirds or split it in however many. A survivorship allows for that equalization so that someone can get an asset and someone else can get a cash payout instead of having to sell off the asset to make everybody equal in that payment. And the reason for the survivorship and the reason that we're doing all this is because of the tax man. Everybody has to pay it. Even upon death, there is a need to pay it. And for 2025, there's a current exemption of 13.99 for an individual and 27.98, and these are millions for married couples. So if your estate is evaluated at over these thresholds, your heirs are going to have to pay an estate tax from that estate. So that goes back to that point that they don't want to have to liquidate assets to pay for this tax, which can be up to a current maximum rate of 40% on the federal side. Not to add on that some states may have an additional tax burden for those heirs. And in general, that federal tax bill does have to be paid within 9 months. There are ways to get some extensions and stuff and some additional filings, but realistically, the taxman is going to come knocking in 9 months saying, hey, you have an estate valued at 50 million, we're taking off the 27.9. You now have an estate worth 22 million that's being taxed at 40%. We need a check for that money. And having that survivorship payment to pay for that tax bill really helps those heirs without having to worry about what is going to happen to the overall estate. I will note that gifts can deduct from these exemptions. So those exemptions listed above are without any giftable exemptions. Definitely speak to a tax professional if a client has been gifting and using some gift exemptions on what they'll do to the overall tax exemption. But realistically, when we're talking about taxes, they're not going to go away. What that amount may be could change. I know that the recent passing of a bill is going to peg it to inflation in the years moving forward, but that could get repealed. That could get a bill 20 years down the line that says something else. Taxes are going to be there. It's just going to be at what amount. What exemption are you going to have towards it? So really setting yourself up for that future tax bill is really what that estate preservation means with these survivorship policies. So people are going to ask, okay, great. Why am I going to get a survivorship policy versus just having some individual policies? So we're going to go over some numbers. We're going to have Kevin and Susan, once again, getting both a $10 million individual death benefit. These are UL products. We're looking at $212,000 and $174,000 for these $10 million death benefits at age 60 at their standard health. That survivorship for both of them is coming in at $123,000, which you're going to think, why is it less than either of them combined? And it really goes back to how insurance companies really factor in that mortality. Men pass sooner than women. So which is why the female rate is lower. But now when you have a survivorship, you have both lives on the policy. So now both have to pass before the insurance company has to pay out. So because they now have two events that have to happen, that allows them to price this cheaper than it would for these individual policies at that same amount. So then I'm going to get the question of, okay, so they both have a $10 million policy. So instead of buying it each individually, they're going to buy $10 million each for a total of $20 million of coverage. So that $20 million of coverage is going to cost them each at the $10 million that we just looked at, $387,000. Well, good news, a survivorship at a $20 million death benefit is going to have that $247,000 premium, which is less than both of them combined. So even when you're looking at, instead of an either or, they're looking at, hey, I want both to be insured for 10 million to equal the 20, a survivorship may be a good way to position that to allow them to have that death benefit that they're looking for at a lower cost. And I will stress that with this and most survivorship sales, although there can be living benefits, there can be cash value access from a policy if it's on a whole life, an IUL, whatever it is. The reason why we focus on death benefit is that the clients that are purchasing these are not normally going to have to access the cash value of the policy. They're really setting up that death benefit for the future generations. They have access to cash within other means, other assets. And so they're not using this as that income replacement that you might have on a normal IUL sale. This really is more a death benefit driven sale and product. Versus having a cash value. So getting that death benefit at a lower premium allows them to use that money that they're saving to help build up their estate.